My name is Nitya, and rental yield forecasting is simply the process of estimating what the return on investment will be in the future when you own a rental property. It means predicting the profits you'll make not just in a year, but in many years down the road. Why we chose this topic? Solving this challenge gives real estate investment companies a huge advantage in a very expensive and competitive market. First, this project tackles a complex prediction problem that doesn't follow a straight line. Being able to look accurately into the future like this provides a significant competitive advantage in real estate. Second, for any major real estate investment, it is essential to have an accurate future prediction, not to just look at what happened in the past. This is the only way to maximize profits. Finally, our method is powerful because it brings together multiple types of data such as local populations, economy, and housing data to create projections that span over multiple years. Now, identifying on which business process the rental yield forecasting is based on. So it is based on the market penetration, which is highlighted here in the Ansoff matrix. It means our primary goal is simply maximizing the profitability of the properties already owned in the existing market. We use the forecasting model to achieve this in three critical ways. So first, optimizing rent. We can predict the long-term profit of even minor rent increases. This takes the guesswork out of setting prices. Then identify weak selling assets. We can quickly identify properties that are underperforming so we can sell them off and invest that money more effectively. And then we can optimize the maintenance and upkeep spending to directly increase the property's net operating income, that is, the profit left after all daily costs are paid. In short, our model gives us the precise instructions needed to drive maximum returns from our current real estate portfolio. Types of data used within the process. Current and historical rent rolls. This is a core financial document showing historical rent income and growth, occupancy and vacancy rates, confirms current tenant demand for the property, historical operating expenses, all costs, taxes, fees, maintenance needed to calculate true profit, which is, in other words, net operating income. Lease renewal patterns indicates tenant satisfaction and helps forecast costly turnover. Comparable rents, external market data to validate your pricing strategy. Time on market or days on market measures rental demand speed. A low DOM equals hot market. Local concession data reveals the competitiveness of the local market. We can use data such as incentives from the competitors to analyze this.
My name is Vedant and I will be discussing about what all analysis needs to be done in order to extract business insights. Starting with historical performance. So in historical performance, we study about past trend, cost and vacancy data to identify trends and recurring patterns. For example, if rental demand peaks during the summer, prices can be adjusted to maximize the returns. Next is market comparison. In market comparison, we evaluate how a property performs against similar rentals in same areas. If other properties charge higher rent for similar features, so we can also increase our own rates. Next is descriptive statistics. It mainly focuses on performance figure like average rent per square feet, yield percentage and occupancy rates in this case. Next is time series forecasting. ARIMA model, as we know, it stands for auto-regressive integrated moving average, predicts future rent growth and operating expenses. Even though it's a small increase in rent, it can guide better financial investment plans. Next is regression analysis. It tells how economic indicators like employment, inflation, and interest rates can affect rental yields. For example, areas with more jobs usually mean higher rents, so invest where growth is strongest. Next is machine learning models. These use large data sets to predict rent levels and property values. For example, adding amenities such as gym, pool, parking, etc. could raise a property's value. Next is discounted cash flow analysis. DCF, it basically gives long-term profitability by calculating net present value and internal rate of return. For example, if a property offers 12% internal rate of return compared to another at 8%, then it's always better to go with financially more rewarding investment. Next is sensitivity and scenario analysis. This analysis helps us understand how key factors like rent, cost, or market trend can impact performance during economic downturn. Next is investment optimization. Basically means to allocate funds across properties to achieve the best possible returns for a given level of risk. This maintains a balance while ensuring both profitability and security.
When we talk about the rental yield and the investment performance, there are some of the key things we usually consider looking at. First, the current rental price for the similar property and the same nearby area, and also how much they are expected to grow each year, which helps to set more realistic incoming goals. Then we look at the running cost like the taxes, insurance, management fees, and the maintenance. This really matters because they directly affect the profit we make from that. Another thing is like the maintenance and the capital expenses. Basically, how much we'll be probably spending on each year, like for the upgrades or the repairs to keep the property in a good shape. And also, finally, we consider the acquisition cost. That's all the money needed to upfront, like for the purchase price and also the closing fee and initial renovation work, etc. Putting all together, this gives a final picture. It really helps the investor make better data driven decisions to avoid any surprise later on costs.
My name is Louis Hanford, and this is the Analytic Interface Design. Regarding prescriptive analytics, the top banner makes a clear prescribed action that creates organizational value. In this case, recommending investing in Camden with explicit value quantifications such as predicted yield, expected return on investment, and confidence. For predictive analytics, the yield forecast chart in the bottom left provides a predicted outcome that influences value. The projection demonstrates how urban rental yields will increase over time, with detailed annotations showing expected income impacts. The interval guidance explicitly communicates prediction reliability, directly informing investment strategy. Thirdly, regarding diagnostic analytics, the yield driver analysis, i.e. the root cause analysis, explains why particular outcomes occur. It breaks down the causal chain. For example, how population growth drives housing demand, in which increases rental prices leading to high occupancy rates, and ultimately superior yields. This diagnosis reveals why certain areas generate premiums versus the market average. The design synthesizes these analytics into actionable strategy. For example, the heat map provides a geographic context with clear legends, while the opportunity table combines predicted yields, risk assessments, and market indicators with explicit action recommendations, utilizing check marks for buy decisions and warning symbols for monitoring. Every design element, from visual hierarchy to clear KPIs to action indicators, supports evidence-based decision making that ultimately creates measurable organizational value.
Hi, I'm Shravanti. This slide maps our core market variables directly to the profitable outcomes they generate. Let's review the three key relationships. An urbanization level is the first variable is urbanization level, how dense and developed a specific area is. Urban centers attracts the renters with the jobs and immigrants. Outcomes comes about it analyzing this gives us to three key outcomes: increased rental yield, data deriving site selections, and optimized property portfolio. And housing supply, the next variable is housing supply, the number of available units. Low supply drives yield up and oversupply pushes rents down. Outcomes are balanced pricing strategies and avoidance of over the invested markets and maximize rental return and occupancy efficiency. Rich demographics is the finally we look at the age demographics. Different age groups from the students to renters have the distinct rental behavior. Outcomes is it comes out this yields the final outcomes a better understanding of tenant profiles, which enables to targeted and property development and marketing of leading to improved tenant satisfaction and rentation. By focusing on these three variables, we ensure our investment and smart strategies and for profitable. Thank you.
Hi, this is Sugun and I'm going to present this slide on variable outcome and its relationship. The first variable is median household income. So this basically means how much money families in an area earn on an average. So if people are earning more, then they could afford to pay higher rents. The outcome would be more people will want to rent home, and due to this more homes will be occupied. Hence this leads to higher rent demand and occupancy rate. On the other hand, due to high demand, property values and rental prices will also increase. Lastly, the investors will choose for good location for property investment. And the second variable we could see is population growth. This basically means how quickly the population in an area is increasing. So for example, when more people move into an area, that would in turn lead to higher demand for housing. So the outcome for this would be higher the population will lead to rise in rental prices and property values. Secondly, the rise in population will lead to higher rental demands and occupancy. Lastly, the investors will choose good locations which are growing and worth investing. Thank you.
I'm Ved, and on this slide, I will be presenting example of big data sources that can be used to analyze and understand patterns in the property and urban market. Real estate listing platforms such as Zillow, Rightmove, and Zoopla provide up-to-date details on property prices, size, and buyer activity, giving a clear picture of current market movement. Census and government data add long-term context, showing population trends, income, and employment, which reveals where growth is happening. Transport data from Google Maps or City API shows how accessible areas are, while social media and search trends highlight what people are interested in and how sentiment towards neighborhoods is shifting. Satellite data from NASA or Sentinel offers insight into land use, weather, and environmental conditions, and smart city sensors measure air quality, noise, traffic, and safety to show local livability. Altogether, these data sources capture diverse, high-volume, and real-time data, thus fulfilling the key dimension of big data, that is volume, velocity, and variety.
Hi, I'm Gayatri and I'll be saying about the predictions our model has made, the data behind it, and what it really means for the business decisions. First prediction. Our model has predicted that the absorption rate in a certain location will increase sharply. And what does absorption rate mean? It basically means how quick the rental properties are getting occupied. If this rate goes high, the number of vacant spaces will decrease. And if the demand is also high, the rental prices will tend to rise. So our model is forecasting that these rental prices will increase over the next 2 quarters. This particular prediction is driven using two key data insights. First, the Google search trends. There's a noticeable increase in the search of rental related keywords in this location. So people are actively looking for the rental spaces. It's a good indicator for the growing demand. Next, the city API data. It says about the transport connectivity of this location to the central business districts. So when it is easy to commute from this particular location, it will attract both tenants and also investors. Our model is concluding that this rental prices and demand will grow over the next 2 quarters. Now let's look at the business implications of this prediction. First, for investors, it will help them to identify high rising areas early so that they can buy the properties before the price even rises and get better long term returns. This is part of acquisition strategy. Next, for the property managers, it will help them to plan and review the rental prices proactively before the market even reacts. So by adjusting the rental prices according to the hiked price which is predicted and by introducing flexible lease terms, it will help them to make most of the price hike and to not lose the existing tenants. Next, asset management. This is basically boosting up the property value by making smart upgrades. Like for example, increasing the parking space and making the interiors modern, etc. like that. So by doing all this, it attracts high income tenants and we can also increase the rental prices in the growing areas. So this whole analytics will help us to understand how the data analysis will help in making the raw data like Google search trends, API data into useful and meaningful business decisions.